Best investments for 2021. For most people, investing is a must if they want to have a comfortable future. A seemingly stable economy can be easily turned on its head, leaving those who haven't planned scrambling for income, as the coronavirus crisis showed. Those who were able to hang on to their savings, on the other hand, could have done well as the market reached new all-time highs in the second half last year. If you've already earned your $600 stimulus check or are expecting another $1,400 in a proposed third round of relief and don't need it right away, spending it could be a good idea. Rather than keeping the money in a non-interest-bearing checkings account, you might invest it to maximize its value. But with some stocks selling at exorbitant prices, what strategies can investors think in 2021? One approach is to invest in a combination of safer and riskier, higher return investments. Why should you put money into something? Investing will provide you with a second source of income, help you save for retirement, and even get you out of debt. Above all, investing helps you achieve your financial objectives by rising your buying power over time. Perhaps you've recently sold your home or got a windfall. Allowing your money to work for you is a smart decision. While investing can help you create wealth, you must weigh the benefits against the risks. There are a range of investment options available, ranging from highly safe options like CDs and money market accounts to medium risk options like corporate bonds and even higher risk options like stock index funds. That's fantastic news because it means you'll be able to find investments that have a range of returns while still fitting your risk profile. It also means you can mix and match investments to build a well-rounded and diversified, and therefore safer, portfolio. Number 1. Savings accounts with high yields. High-yield online savings accounts are accessible platforms for your money, much like a savings account collecting pennies at your local bank. Online banks usually offer significantly higher interest rates due to lower overhead costs. Plus, you can normally get your hands on the money by converting it to your primary bank or using an ATM. For those who may need cash in the near future, a savings account is a good option. Risk. Since the banks that sell these accounts are FDIC insured, you won't have to worry about your money vanishing. Although high-yield savings accounts, including CDs, are considered safe investments, you risk earning less when you reinvest due to inflation. Savings accounts are about as liquid as it gets when it comes to money. You can add or delete funds at any time, but your bank can enforce a legal limit of 6 withdrawals per statement duration if it so chooses. Number 2, deposit certificates. Banks issue certificates of deposit, or CDs, which usually pay a higher interest rate than savings accounts. The maturity dates of these federally insured deposits will vary from a few weeks to several years. Since these are time deposits, you can only take the money out after a certain amount of time has passed. The financial institution pays you interest on a CD at set intervals. When it matures, you earn your initial principal plus any interest that has accrued. It pays to browse around for the best prices online. CDs are a good choice for retirees who don't need immediate income and can lock up their money for a while because of their protection and higher payouts. However, there are a variety of CDs to suit your needs, so you can still benefit from the higher CD prices. CDs are considered low-risk portfolios. However, as we saw in 2020, they come with reinvestment risk, which means that as interest rates decline, investors will benefit less as they reinvest principal and interest in new CDs with lower rates. The danger is that prices will increase, but investors will be able to gain because their money is already locked into a CD. Consider laddering CDs, which entails investing money in CDs of different terms so that your money isn't trapped in one instrument for an extended period of time. It's important to bear in mind that inflation and taxes could eat away at your investment's purchasing power. CDs are less liquid than savings or money market accounts because you keep the money in the CD before it matures, which may take months or years. It's possible to get your money faster, but you'll almost always have to pay a fee. Number 3, bond funds issued by the government. Government bond funds are mutual funds or exchange-traded funds that invest in debt securities issued by the government of the United States and its agencies. T-bills, T-notes, T-bonds, and mortgage-backed securities issued by government-sponsored companies such as Fannie Mae and Freddie Mac are among the debt instruments in which the funds invest. These government bond funds are perfect for investors who are searching for a low-risk investment. These funds are also a strong choice for new investors and those looking for a steady stream of income. Risk. Government debt funds are considered to be among the best assets since the bonds are backed by the United States government's full faith and credit. The fund, like other mutual funds, is not funded by the government and is thus vulnerable to risks such as interest rate volatility and inflation. Purchasing power can be eroded as inflation increases. Current bond prices fall as interest rates increase, while existing bond prices rise as interest rates fall. Long-term bonds have a higher interest rate risk. Bond fund shares are extremely liquid, but their value fluctuates depending on interest rate conditions. Number 4, corporate bond funds with a short maturity. Corporations can raise funds by issuing bonds to investors, which can then be pooled into bond funds that hold bonds issued by dozens of different companies. The average maturity of a short-term bond is 1 to 5 years, making them less vulnerable to interest rate volatility than intermediate or long-term bonds. Investors looking for cash flow, such as retirees or those who want to reduce their total portfolio risk while still receiving a return, should consider corporate bond funds. Short-term corporate bond funds, like other bond funds, are not insured by the Federal Deposit Insurance Corporation, FDIC. Investors in investment-grade short-term bond funds typically earn higher returns than those in government and municipal bond funds. However, greater rewards come with a higher degree of risk. There's always the risk that a company's credit rating will be downgraded or that it will run into financial problems and default on its bonds. Make sure your fund is made up of high-quality corporate bonds to mitigate this risk. Any business day, you can buy or sell your fund shares. Furthermore, you can usually reinvest income dividends or make new investments at any time. Only bear in mind that there's a chance you'll lose money. How much money do you have to invest? How much money do you have to put into an investment? The more money you have to spend, the more likely it is that higher risk, higher return investments would be worthwhile. If you have more resources, it might be worth spending the time to learn about a particular stock or industry because the potential rewards are so much greater than with bank products like CDs. It might not be worth your time if it isn't. As a result, you can either stick with bank products or invest in ETFs or mutual funds, which take less time. These products may also be useful for those who wish to contribute to their account in small accounts, such as 401k members. In conclusion, investing can be a great way to create wealth over time, and investors have a variety of investment options to choose from, ranging from low risk, low return assets to higher risk, higher return assets. To make an educated decision, you'll need to know the advantages and disadvantages of each investment option. Many investors manage their own money, despite the fact that it can seem overwhelming at first. However, the first step in investing is simple. Open a brokerage account. Even if you don't have a lot of money, investing can be surprisingly inexpensive. If you want to know more financial tips like these, make sure to give this video a like and click subscribe. Thanks for watching, and see you in the next video.